Hello and welcome. In this video, we'll be diving into the recent developments in Japan's monetary policy and the potential impacts on the global financial market. As Japan's central bank contemplates relaxing its grip on the bond market, the implications stretch far beyond the country's borders. Let's explore the factors at play and what they could mean for investors worldwide. Recent market movements have put Japan's central bank, the Bank of Japan (BOJ), in the spotlight. With the yen hitting a 33-year low and government bond yields reaching their highest levels in a decade, the BOJ's policies are undergoing scrutiny. These changes have prompted discussions about potential adjustments to the unconventional yield curve control policy. You might be wondering, why is the rise of the yen and government bond yields causing such concern? Let's break it down. Japan's central bank, the Bank of Japan (BOJ), has been employing a unique policy to control its bond market. This policy involves purchasing government bonds to keep their yields at a fixed level, essentially regulating borrowing costs for businesses and individuals. Now, the recent surge in the yen and bond yields has put pressure on the BOJ to reconsider its strategies. A stronger yen makes Japanese exports more expensive for foreign buyers, potentially impacting the country's economic growth. Simultaneously, higher government bond yields mean increased borrowing costs for the government, potentially leading to budget constraints and reduced spending on vital initiatives such as infrastructure and social welfare. This delicate balance between currency values, borrowing costs, and the overall health of the economy necessitates careful decision-making by the Bank of Japan. As we delve into the anticipated modifications in the BOJ's policy, it becomes clearer why these adjustments are critical not only for Japan but for the global financial landscape as well. Let's explore what these potential changes could mean for investors and the broader market. Market experts anticipate that the Bank of Japan will likely make adjustments to its existing policy. Speculation suggests the BOJ might widen the band within which 10-year Japanese government bond (JGB) yields are allowed to trade, potentially raising the target yield from 0 to about 0.5%. While some institutions expect a complete scrapping of the yield curve control, others believe the BOJ might stick to its current framework. Despite 18 months of above-target inflation, Japan has maintained its policy rate at -0.1%. However, the growing gap between borrowing costs in Japan and other major economies, such as the US and Europe, has intensified pressure on the BOJ to consider policy tightening, especially as the yen continues to weaken. The weakening yen, which surpassed 150 yens against the dollar, has raised concerns about inflation as the cost of imported goods rises. While the Japanese government may be contemplating a fair exchange rate around 152 yens, 153 yens, currency traders anticipate further challenges ahead if the BOJ maintains its current course. Balancing sustainable economic growth. The BOJ has emphasized the importance of sustainable signs of wage growth before implementing significant policy shifts. With wage growth showing some impact on prices, economists are closely watching for any acknowledgement of a stronger correlation between wages and inflation. Given Japan's significant ownership of US and European debt, any changes in Japan's bond yields could trigger a domino effect in global markets. While some investors may consider repatriating their capital, the attractiveness of JGB yields remains a crucial factor in their decision-making process. To summarize, Japan's potential monetary policy shift has caught the attention of investors and market watchers globally. The yen's fluctuations, inflation dynamics, and the BOJ's upcoming decisions will not only impact Japan's economy but could also have ripple effects in international financial markets. Stay tuned for further updates on this developing situation. Thank you for watching, and don't forget to subscribe.